So, Professor McCaffrey, please present what you're about to present.
All right. Well, thank you very much. We're going to have a little experiment in self-binding constraints here because I've agreed to come in at 25 minutes, and that's in part because Stranad, who's my mentor and good friend, has slides that will take 15 minutes just to read. But I think it's a good shift. It's a good sort of life cycle shift to take some of my time and give it to Jeff. But so I'll be quick. I want to thank everybody, certainly John and George and all the conference organizers. It's great to be in Houston and meet some many new friends and see some old faces or at least familiar young faces. So that's all fun. I was also very thankful that I was asked to write on this topic. I went through last night and I did the known, unknown, bold stuff to sort of get with the program. But in writing about it, I've been thinking for a while about the relevance of behavioral economics, as I think Tom cited the other day. I wrote a paper in 1994 on cognitive theory and tax, and then I've co-authored with Danny Kahneman. I have an NSF grant with a psychologist, John Barron, at Penn. We've studied a lot about how people perceive tax, and I've just had a co-edited volume come out with Joel Slemrod called Behavioral Public Finance. Jim, I got to thank Jim for his blurb on the back. I got to pay Jim for his blurb on the back, which is very nice. But so I've been thinking about it a lot, and then, but I've always thought there's something not quite right in the water because the way people sort of use behavioral economics, the way I see it being used in tax policy, isn't the way I think about it. Isn't the way I think serious behavioralists think about it. So there's something ad hoc. So I have a line in my paper about what we've been doing is using ad hoc findings in an ad hoc way for ad hoc reform, and that's wrong, that's what we shouldn't do. So I ended up writing this paper, and there's sort of references to Groundhog Day, the movie, and I had a lot of fun writing the paper. But I wrote it sort of against the kind of charge that I was given, and hopefully it's a case study. I think it's a case study about the importance of being fundamental in fundamental tax reform. I think it's also a case study to the sort of non-believers, the people who aren't generally, they're still fighting this battle, which I think is getting a little old, but the sort of, the kind of arguments that Richard Epstein and Richard Thaler have about the relevance of behavioral economics, people are still sort of fighting that. And I think one reason, a lot of the way behavioral economics is used is just kind of ad hoc and sloppy, and it gives it a bad name. So that's sort of the theme here. So going through, because I'm supposed to be talking about the relevance of behavioral economics to fundamental tax reform, in my paper I actually quote the charge of the conference organizers. And it's very clear to figure out what they were thinking, which is fundamental tax reform, as we all now know, is largely about, we all knew anyway, is largely about income versus consumption, the base questions. That's tied up with savings and the taxation of savings. And there's a thought, the importance of behavioral models of how people save is central to this. So we begin with the usual view of savings behavior. And we start with this idea that people should save, the life cycle hypothesis of Modigliani and Brumberg from the 1950s. So people should. It's sort of dynamic, long-term, utility maximizing. We add to that, and I could have put bold in here, known, people don't save, which we take as a fact. It's a very prevalent fact. It's a dominant fact. Anyway, you cut through the micro or macro thing, most Americans don't save. The modal savings is zero. The median savings is zero. Most Americans just don't save. We're talking about very few. So then we add to this that people are stupid, which is the behavioral life cycle hypothesis. Now, there's supposed to be some laughter there, so I'm glad that you laughed. But it seems to follow from that, so something's wrong. So then we get a behavioral model. And the behavioral model, which, the behavioralists have rushed into this too, I do not think they're totally at fault. I don't think they're at fault at all. I think they're right. But it's the relevance of the behavioral economics insights to fundamental tax reform that I think is wrong. One of the lines I have in the paper is, it's like all unhappy marriages. The two sides aren't listening and they don't understand each other. So there's a lack of understanding among the behavioralists of how the tax system works, and there's a lack of understanding among tax policy, applied public finance people, about what behavioralism is doing and can do. So the standard behavioral economics insights are that people are myopic and they lack self-control. You can add sort of common sense to that. We all sort of act for the present. We have a present bias, and this is very easy to elicit in experimental settings, and it's very easy to observe in ordinary life. There's another feature. There are other features as well, but people use mental accounts. They don't understand the fungibility of money. So if you win the lottery, you go out and binge on a bunch of things, even though you have very pressing needs and wants that you should be paying for. You just don't do that. You think of different pots of money differently. So there's a salience effect, there's a focusing effect, there's a stickiness to the status quo, a status quo bias. And basically the thought among fundamental tax policy when they go, or fundamental tax reform people, when they look over to behavioralism is, let's put these two biases together. So let's trick people by mental accounts, by salient, focused savings vehicles. Let's trick people into doing what's in their own best interest to do. And basically everybody says that. There are just lots of people. I'll spare them. Doug Bernheim and Alan Auerbach mentioned the possibility without specifically endorsing it. I have to say that because I'm going to see Alan next week, and he's nasty. If he looks like he doesn't look that way. He always looks so calm. All right, now here are the problems with that traditional view. So let's take that as the traditional view. And here are the facts, and I went through last night, and I put this in bold. We've actually had ad hoc tax-favored savings vehicles in place since the 1940s, when we engrafted the pension, the defined benefit pension rules onto the income tax. What I mean by ad hoc tax-favored, it'll become a little more clear as I go through. It's in the analytic structure of tax. So we have an income tax, which we put in place in 1913, which is supposed to double tax savings. That's the point of an income tax. It double taxes savings, right? We knew that since John Stuart Mill, at least. And then we decided at some point that we actually want to encourage savings, or we don't want to discourage savings. So instead of changing fundamentally to a consumption tax, we start sticking on pro-savings vehicles. And that's something we did in the 1940s. Then in the 1970s, we had traditional IRAs. By the late 70s, we had 72 articles about the efficacy of traditional IRAs that exponentially multiplied going into the 80s. In the 1980s, we actually introduced 401ks in 1978, but it took the Treasury 3 years to have regulation. So 1981, 401ks started. 1990s, we got the Roth IRAs. And then, as I say in the paper, like a football coach who just keeps running the same play until it no longer works, except there's no evidence that any of these things have worked. In the 2000s, the barn doors opened. There are lots of metaphors you could use. The stuff has hit the fan. And we have educational, health, Roth 401ks, lifetime savings accounts. I'm actually, as I was writing this paper, someone in Los Angeles was calling me up to see if I would serve as an advisor and on the board of a nonprofit. He has a disabled son, and what America needs is a tax-favored savings plan for disabled children. And, well, don't read my paper and don't call me back. But so these are the facts. For 60 years, we've had tax-favored savings vehicles. They're multiplying even as we speak. And then people don't save, which is also known. Now, here are comments, and this is where I think it gets into the case study stuff, about behavioral economics as I try to practice it, as I think Danny Kahneman does. I think Matthew Rabin just got the John Bates Clark Prize a couple of years ago. And if you look at Matt's essays on psychology and economics, people are trying to do serious stuff. They're not making it up. They're very, very smart people. Colin Kammerer, whom I work with, lots of very smart people. And they think they're doing something which is quite principled and quite structured. So 4 sort of ground rules of how I think we should be using behavioral economics. One is that the analytic structure matters. Competitive general equilibrium works not because anybody understands it, and we didn't even know it. We didn't formalize it until 1954 with Arrow DeBrew. And that's not the mechanism by which markets are supposed to work. It's not through the individual understanding of market mechanisms. So that structure matters. There's nothing in behavioralism that tells us we can throw out the facts of the matter. And we'll see the facts of the matter in a minute. We'll see what it is that a rational person would do. What is the law? What are the analytics of these savings vehicles? And that matters. Second point, which I know Jeff is going to riff on in his commentary, and we heard it just before the break too. We've heard it throughout. People are not all the same. There's a tremendous heterogeneity. So the debate in the literature, I think we're all sort of addicted to these representative agent models. So people are either rational life cycle savers, maximizing this dynamic optimization problem throughout their lifetimes, or they're like living for the nanosecond. But in fact, people are different, and people save for a lot of different reasons. So some people are bequest savers. Some people leave bequests because they're just inept life cycle savers. Some people are precautionary savers. Some, many, maybe most people are myopic, but not all people are myopic. And obviously the people who are saving, which are people, there are people who are saving, they're not the hypermyopic. Third point is that people are not stupid, and behavioral economics people don't walk around thinking people are stupid. We're very proud of the fact that we're boneheads too. We make the same biases. So the biases we have often work. There's a reason they're out there. The real world counteracts the biases, and that will be an important part in the story. And then, by the way, there are rational reasons not to save in the institutional structure of society. So I'm not sure it really makes sense for a low-income worker in America today to really scrimp and save. For one reason, if you have pots of money, they might get taken away by means-tested or asset-tested government programs. For another reason, even if you are a rational life cycle saver, you might have optimism, which might be rational or irrational, but it could be very instrumentally helpful. It's good for your health. So you may think somewhere in the future a Democrat will be born in distant lands who will come to America and provide meaningful in-kind support so that life will be better, and under those circumstances, or your spouse will start to work, or you'll get a spouse, and you'll get a spouse who has a stable job. You'll get the minimum wage laws will go up. So all these hopes might keep getting dashed, but it's not to say that people are irrational for having those hopes. I actually wrote another piece in 1994 on saying that it's rational to play the lottery. There's like a kink in the social utility function. It doesn't help you any to have a couple $100 in the bank. The one thing you want, if you have a few dollars left at the end of the week, is the chance of getting out of your life, transforming your life, sort of indivisibilities in your utility function. And then the final point here is that actions like savings take place in the world. And there's a distinction in cognitive psychology between how we think, where we make the mistakes, and how we act. And actions endure over time, so that institutions matter. My big sort of holy grail pitch for behavioral public finance, because most people have done behavioral private finance. In behavioral private finance, arbitrage against the heuristics and biases is a private good. If I can trick you all into paying above marginal cost pricing, more power to me. It's the arbitraging of someone who's going to come in and undercut my price and get marginal cost pricing, which is a private good to my competitor. That's what makes things work. Markets work because of private self-interest. But in the public sphere, in public finance, if I could convince all you people that the corporate tax really is a regressive tax, 200, 300% borne by labor, because it's not pounded at 100%, damn it. If I could convince you all of that, and say that there are actually welfare gains on the table, so we could have a Pareto superior improvement, we could follow Kaplan-Chevelle, everybody could be better off if we could just get rid of the corporate tax. If I could explain that, first of all, I don't get elected. Second of all, I can't capture any of the welfare gains for myself. Nobody gives me a prize for trying to explain that, and basically we're not out there trying to explain to the people that the corporate tax is a regressive, inefficient, unfair tax. So that's the basic setup here. Those are some things that matter. Now, the analytics, and here I think we can be pretty quick, because I think you all know this. It's been interesting over the last day and a half, sort of a shift in the vocabulary. Within the legal academy where I live, people still talk about prepaid and postpaid consumption taxes, and they focus on their equivalent. So it's been nice to see other people writing. Alan sort of writes this way, as if a consumption tax, their wage taxes, which are what we think of as prepaid consumption taxes, there are consumption taxes, which is what we think of as postpaid cash flow consumption taxes, and then there are income taxes. But in any event, you've got an income tax, which is supposed to double tax savings, and you have these two forms of consumption taxes, prepaid or postpaid, Roth IRA or traditional IRA. Now, here's the problem with the traditional view. The first problem with the traditional view is the facts. We've had ad hoc tax-favored savings vehicles for 60 years. We're getting more of them by the week, and our savings rate is going down, and most people don't save. Now let's look at the theory. If we have prepaid consumption plans, which, by the way, are the trend, all the Bush proposals are for prepaid consumption plans, the Roth-style accounts, there's no reason that these plans would incentivize. They're certainly not going to do anything for myopic individuals. So savers simply put their old savings into the Roth-style style accounts. There's no help for the middle class living paycheck to paycheck. There's no help for the myopic. There's no cash flow relief there. So the result is no new savings, and in fact, there's no reason not to consume, not to dissave. So the existing capital under the sort of prepaid consumption plan can just spend down all their wealth tax-free. In fact, as I say in the paper, you might have to be sort of hyper farsighted and maybe naively farsighted, because a lot of things aren't even, they're not set in the law yet. They might expire. So you have to sort of, you're an anti-myopic person if you're putting money into Roth IRAs. So that leads most people, like Alan, other people who are thinking, all right, well, let's do something, to sort of gin up savings, to go the postpaid consumption, or what public finance people are now calling a consumption tax. But here's the problem with that. Taxpayers can put money into a traditional IRA with one hand and run up debt with the other. So I teach this to my students just because I can, and I do, and I think it's a public-spirited thing to teach my students. Gets to be April 15th, I say, you have an IRA, they don't have an IRA, I say you can open one until midnight tonight. You don't have any money, take $2,000 on a credit card, open an IRA, immediately save $700 if you're in the 35% bracket. Immediately, right then, right there. Not rational. We're arbitraging the principal, because the principal is not principal of debt, not income under an income tax, is deductible with the postpaid consumption tax model. It's not rational, but it's myopic, so we're actually helping. So there's a point, an Urban Institute study from Gene Sterling and two co-authors showed that in 2004, the tax expenditure budget priced out the cost of savings incentives as higher than the actual new savings. And I know there are problems with how we calculate savings, but that finding suggests that the government is subsidizing present consumption through tax-favored savings plans. Basically what it suggests. And there are rational reasons why that would happen. So there's a tax deduction with no new savings. There's more money today. Another problem with the 401k, the traditional IRA, there's a money illusion. Basically what's going on in that arbitrage thing is you're neglecting the tax that ultimately will come due. You look at your balance, you think you're rich. You think you're richer than you are. You go out and spend. Another problem is that we actually force people in these postpaid consumption plans into a life cycle model, whereas perhaps the best savings, the biggest pots of money that last for the longest time, might be intergenerational. But these accounts get very heavily taxed. If you're within the estate tax target range, the conjunction of the income in respect of decedent and the estate tax means an IRA. If you guys have traditional IRAs and you die with them, I know about you guys because I'm trying to figure out who's in the estate tax target range, but if you or you and your spouse are above $4 million, 75%, more than 75% of that IRA is going to get taxed at your death. So we're forcing that money out into a life cycle model, whereas maybe the best savings come otherwise. Now here's the deeper problem with that. The reason to suspect that taxpayers will arbitrage is not hyper-rationality. It's not that they're solving long-term dynamic optimization problems, but that they're myopic. So the very same behavioral tendency on which you predicate the behavioral patch is what's going to undermine the efficacy of the behavioral patch. So postpaid accounts give more to consume today, they increase your present cash flow, and they create the money illusion. And then the institutions of society, like credit and retail markets, have every incentive to foster arbitrage. As I say in the book, you're not going to stop getting offers for credit cards or no money down financing because the government has instituted some traditional IRA or lifetime savings accounts. So instead of the institutions of society working towards sort of an efficient equilibrium, they're just conducive to myopia. So that's a problem. So I think behavioral economics, best understood, suggests that the ad hoc approach is very unlikely to work. That should be the theory. And then when we look at the data, basically it confirms that. I know, people do endless sort of studies about the efficacy of these things, but they don't seem, at a crude, commonsensical macro level, to be very efficacious. So what I say is that behavioral economics, this understanding of behavioral economics, and I think there's another very important role for behavioral economics, which is in the selling and explaining of tax reform, which is a theme throughout these past day and a half. So everybody says it takes presidential leadership, that people have to get behind it, but then everybody says things like people don't understand. They don't understand incidence, they don't understand tax equivalence. Well, that's where I think behavioralism matters, because there you're very close to the cognitive space The thought is the action. It's the way you vote. It's the way you speak to a public opinion pollster. We're not looking at an actual action like savings that, by definition, endures in the real world, where there are specific actors with an economic incentive to arbitrage against it. So behavioral economics, I think best understood, supports fundamental comprehensive tax reform. So rather than tighten the anti-arbitrage rules, and I know Jeff is going to do some speaking on this, and I don't think there's any, I do, I think it's the wrong strategy, but it's a strategy not inconsistent with my strategy. So one thing to say is, well, let's really make those accounts sticky so that people they can't pledge against them. They can't borrow against them. They can't take the money out until they're 59 and a half. It's not an asset in bankruptcy. And all that does is just drives up the transaction cost of arbitrage. And one thing, I think the political economy of this is you've got special interest winners, financial intermediary winners on both sides. So within the IRAs, within the 401ks, people are getting big fees. Very often those very same companies are getting the credit card interest on the other side. So they're very happy with the status quo. But, so the tightening the anti-arbitrage rules means let's look at those accounts and really make them sticky so the mental account holds. There's something, I am going to say something about that, but not in the context of tightening the rules on the ad hoc things. What I say is just consider a progressive cash flow consumption tax. And then what you've done is you've changed the default rule. You've made it impossible to arbitrage not by looking at the account. So the Copernican revolution is inverting the sun and the earth. But so we're saying, well, let's stop looking at these accounts and trying to have sub-rules that make the accounts work. Let's look at the background default rules. And if we had Larry Kolikoff's, fair tax, you wouldn't be able to arbitrage. You'd really have to pay that tax when you consumed. So that's sort of the suggestion. Now, one thing that does is it lets intergenerational savers be intergenerational savers. So my proposal is a progressive consumption without a state tax. Tax equivalence, that is an accessions tax. The tax will come due at the heirs when the heirs spend. So we have a zero basis. But we haven't chilled these sort of long-term savers out from savings. And then here's a point relevant to Jeff's comments too. I think it's another analytic mistake to say, well, if we do that, if we do fundamental tax reform, then we don't have to do any of these sort of ad hoc things. In fact, I think that's wrong. There's no reason not to do things like Richard Thaler's trademarked Save More Tomorrow plan, or the Choi, Leifson, Madrin metrics study of the importance of having the default rules set to be in 401k plans. Not only should you do those things with the background system of a cash flow tax, but those things are likely to work in a system with a cash flow tax. So there's no reason why we can't do that with the private or public sector. As an aside, something I probably could have put in earlier, just why care about savings at all? And there's sort of micro reasons and macro reasons. A lot of economists, you guys kind of straddle. You straddle whether you're talking about compensated or uncompensated, whether you're talking about real effects or you're in the deadweight space. You straddle whether you're only concerned about micro foundations or macro things. And my point here is that the reasons to care about the macro, even if everything is micro, even if the only problem with savings is that people are bonehead, they don't save enough for themselves. And one reason to think, I think there are a bunch of reasons to think about that, but one reason is a sort of acceptance of the impossibility. Most people will not save for themselves. So if we care about the macro, if we care about the micro, we need some people to oversave to get the right amount, given that some people will undersave. And it's also worth pointing out that the macro capital stock is a public good. It has sort of non-robberous, non-exclusive things, and we're not going to get it just summing up micro decisions. So social policy might best accept that most people will not save. What we can do, sort of a two-step thing, provide non-fungible in-kind support, like health and old age insurance, things that really, not ad hoc plans with difficult to arbitrage rules, but real in-kind benefits that help people who haven't saved for themselves. And then let super savers oversave. Just get out of their way. Let them save dynasty trusts. So the bottom line here is that fundamental tax reform should be fundamental tax reform. It shouldn't be ad hoc. We shouldn't be using behavioralism in an ad hoc way. We should still build models, test models, look for things. One final slide, which is, my sort of pitch, which I think was on George's list I think was on everybody's list of non-starters. So I'm an old cash flow, USA Tech, tax that includes debt, Bradford, Andrews, Calder, cash flow income tax. I wrote a book called Fair Not Flat, because I think there's no reason you have to have a flat rate. So if we had a consistent consumed income tax, which would basically be also not radical change, unlimited deductions for IRAs, and include debt, those are the changes. Repeal the limits on contributions to IRAs and find a way to tax debt. Those are the only two changes you have to make. And this would encourage savings for ordinary purposes because you'd have progressive rates. It would tax capital when its yield is used to elevate lifestyles. It discourages debt. If you don't discourage debt, there's basically no reason to encourage savings. It encourages real savings across generations. And I think it doesn't contradict, it fits with the most important lessons from behavioral economics. And then I think I'm good at 25.
You're good.
So I should issue my standard disclaimer, which is that I don't believe anything I do. Okay, thanks.
You have to blow up.
So actually, if I didn't have this on the slide, I wouldn't have to say it because you wouldn't know that I work for the Joint Committee on Taxation. But since it's up here, I'm going to issue the standard disclaimer that my views don't represent the views of the Joint Committee on Taxation. And I also would like to thank the conference organizers for inviting me. I do have to give the following caveat. I'm not very familiar with the behavioral economics literature. John told me when he asked me to discuss the paper that all the real behavioral economists were at some other conference right now, so he was going to have to make do with me. And I guess one reason that he might have thought of me is he knows that in the work we do at the Joint Committee, we try to focus very closely on thinking about what we expect people actually to do, because our job is to predict changes in the next couple of years. And so we maybe are a little more oriented to what Ed calls ad hocery in analysis. He left out some of the more fun statements in his paper from his slides, and I put them in. His very first sentence, at least in the draft I saw, was, "I come not to praise behavioral economics and its relationship to fundamental tax reform, but to bury it." Did you take that back out?
No. My second sentence is at least in the way people are using it. But
okay. But I had the impression, since this is your area, that was kind of meant to be like a startling opening. But my second point is, it is, I thought, a little misleading, because then you go on to talk quite a bit about what behavioral economics can tell us about what can be done and what can't be done. So I'm not sure so much that you mean it doesn't have anything to say, is that you have to be careful how you use it. And on the other hand, in the end, you say, well, I can marry behavioral economics with tax reform, but the point is that you need to have a really fundamental tax reform if it's going to work. At the end, I'll talk a little bit about how you see which piece you see working, which is the, I'm thinking of marketing, but I know you all have a different word for it. And I see the marketing differently. So why is there a difficulty in linking behavioral economics and tax reform? I went back to your introduction, I guess, to your volume with Jill Summer. And I think when we think about global tax reform, we think of a big regime change. And yet behavioral economics, in this quote, is the field self-consciously lacks a general field theory of human behavior. And when we're trying to model what's going to happen with tax reform, we kind of need a general field theory of human behavior. So trying to bring the empirical and experimental observations that you get from behavioral economics and combine it into something that you can use to predict behavior is maybe a little more puzzling. Quite a bit of the paper talks about these tax-favored savings accounts. And I thought I would just add a little more to that, because that is something that we look at a lot where I work. First, to put it in context, the two types of goals for reform that you talk about in the paper are encouraging savings and simplifying the tax code. And the way behavioral economics contributes to the theory is that it explores deviations from the rational utility maximizing economic models, which is some economists are very uncomfortable with this, and some can work with, because then it's much harder to predict what's going to be going on. One of the deviations that is observed is people don't appear to be saving the way they should under lifecycle theory. So why is that? Well, I think this is one area where economists who are not comfortable with abandoning that theory feel that's an unknowable thing. But behavioral economists feel, well, that they have some theories for it. And I picked up the first thing that you picked up, and then I picked up a couple other of the ones that were discussed in the paper. The one that struck me the most, and the quick reading that I was doing, is a lot of the inconsistent behavior can be traced to myopia, either imperfect information or an extremely high discount rate. At least that's how economists would talk about it. And in fact, I was struck by, I'm not so sure why this is a big deviation, because economists can embody this myopia and this lack of self-control just by putting in a big enough discount rate, or close, I would think. Alan's shaking his head, so he can explain later, but I actually did have an introduction to this type of linking psychology and economics back in the first year in graduate school. There was an experimental course called Crime, Human Nature, and Public Policy that was team taught by an economist, a political scientist, and a psychologist. And they all brought to bear their discipline to explain why crime existed, and it all came down to discount rates, basically. So, and that happened actually before this whole literature started. I'm embarrassed to have to. And then the final thing is that there seems to be an inertia that you wouldn't expect with a rational actor, that people seem to have a preference for the status quo that goes beyond what it would be just from a utility maximizing. So, what do we know about, I want to go back to retirement savings vehicles and what we do know about them. We have all sorts of different possibilities, IRAs, 401ks, various defined benefit plans. The deduction and exclusions are most valuable to taxpayers with the highest marginal tax rates. So we would expect to see, under rational economic modeling, those people being the ones to use it. The contribution amounts per year are limited. There have been numerous studies that have attempted to examine whether these vehicles result in a net increase in savings econometrically. We can see a net increase in the use of these vehicles under various circumstances, but what we don't know is whether there's arbitrage or substitution going on. And we do know that higher income individuals use them more than lower income, which is sometimes consistent with the relative tax subsidies, not always. But Ed doesn't like this solution to increasing savings, which he terms ad hocery in the paper, and I had to put that in because I like that word. And because he said there's little reason to think that these vehicles solve the observed problem of people not wanting to save, and he goes back to the idea that we really can't tell whether they're saving more or substituting, and we know that it's easy to substitute. I wanted to show a little bit about give you an idea of the change in savings rates over income. The horizontal axis is income decile. So, and the vertical axis is the percent of participation in various types of 401k type retirement plan. Okay. So joint filers, you have less than 20% participating, and the various types of single filers, and on average, you have less than 10% of the bottom decile participating. And when you get to the top decile, you have 80%. So there's some rationality there to the extent we have a progressive income tax system. It also, though, could be explained by liquidity constraints. Now, more recently, we've had more generous savings vehicles. And in particular, I wanted to show some evidence that two of my colleagues, Gary Koenig and Rob Harvey, have collected on analyzing the use of the Savers Credit that was enacted in 2001. The Savers Credit provides, it's a graduated rate depending on, it's actually declining graduated, depending on your income level. So if you put money into a front-end IRA, if your income's below $30,000, you get a 50% credit. 30 to 32,000, notice the very tight phase-out range, you get a 20% credit. And then up to 50,000, a 10% credit. In 2002, if you look at the last column there, my circle missed a little bit, the average usage is 14%. The highest usage is with the 10% rate, and the lowest usage is with the 50% rate, which would seem to not make sense if we're thinking that everything is driven by marginal benefits. But what we can observe is we're probably seeing a high liquidity income effect there, since the 10% people have higher income. But still, the highest rate is under 20%. And this just shows 2002 and 2003. I don't know how well you can see the numbers, but 2003 just goes up a little bit relative to 2002. So you might have thought, well, 2002 was the first year, nobody knew about it. You would expect to see a bigger jump in 2003. You didn't really see a big jump. But the most interesting thing is they did an analysis of people who, to claim the credit, they already had the savings vehicle, they met all the income requirements, all they had to do was fill out the right form and they could have gotten the credit. There were 3,000 returns in thousands, 3 million returns, where people met that characteristic and they didn't take their credit. So that is a little disturbing for people who might think that you're trying to incent behavior with tax policy. If there's people aren't even following tax policy enough to take advantage of something they could have had just by filling out a form, and that it adds up to a third of the taxpayers who were eligible for the credit who didn't take it. So there we have some, I guess, information deficit would be the best behavioral economic. And then this just gives a little breakdown about who didn't take the credit. So all of this kind of confirms that, yeah, there's some irrationality, and is there anything we can do short of fundamental tax reform to provide savings incentives? And I'd like to say that some of the experience with this credit, as well as some other similar experiments, show, well, yeah, behavioral economics can help you at least get people to use the vehicle, and maybe some of them will increase savings. This credit, these are kind of the bare minimum description of what it takes to get it, and I'm not going to read it, I just wanted to show you the volume. It's complicated. Of the people who were eligible for the credit, 76% of the taxpayers who use a tax preparer or software did claim the credit. Only 44% who did it on their own claimed the credit. So we can see some evidence for information, but one of the puzzling things is why only 76% who had help claimed the credit. But we can, so the gist though is information probably helps, education probably helps. And there was another experiment by Dufflo et al. With H&R Block, where they did a similar thing but with a much simpler credit, which is H&R Block just randomly, they had been trying to establish a retirement savings vehicle that they would try to steer their clients into when they filled out a return and got a tax refund. And they did a study where they gave randomized credits to people at different rates and looked to see what the usage was. And they did find that the contributions increased depending on the amount of the match that they gave. So we have some rational behavior there. A regression analysis of the people involved in this study showed that The usage of it also increased with income, consistent with the saver's credit, the size of the refund, and particularly the amount of investment income, which gives some credence to that market basket part of behavioral economics. But again, and it also showed that some preparers got more people to take it up than others, which shows that education probably is a piece of information. So there's some hope for taking some lessons for just ironing out information, making things simpler, and maybe you can get a little more use of these savings incentives. And then everybody knows about, I think everybody here knows about the default option on the 401k. Again, it isn't exactly a rational response, but it's something that can be done. So what we know is that even fairly deep subsidies don't incent a lot of savings, but you can increase it a little. What we don't, well, a lot of use of savings vehicles. What we don't know is how much savings it causes. And we know that these vehicles increase the complexity of the tax code, which falls afoul of the other object of reform that Ed talked about. So I'm going to move ahead. Basically, he already told us he wants to move to wholesale consumption tax, and the way he thinks that behavioral economics would be most useful in moving to a consumption tax is that it will help with framing the debate. Since individuals seem to be very responsive to the way a choice is presented to them, we can learn from that, and that will help sell tax reform. And my main comment on that, working where I do, which is for Congress, is we're way behind on this. Politicians and the people who lobby them, we knew all about framing since the tax code began, and they've been working it hard. And I don't know if we can hold out that much hope that behavioral economics is going to give us an edge there, but it might be a noble endeavor.
So I'd also like to thank the organizers. It's a great conference, and it's wonderful to be here. Everything's wonderful, the substance and the style, everything. So I left my affiliation out, so I don't have to disclaim anything here. I'm going to skip through my first slides, which summarize the paper, because Ed did such a good job. On the main arguments of the paper, there's two. The last 2 bullet points are the ones that I'm going to look at a lot in this talk. One is the strong claim that these AHTFV, by the way, means ad hoc tax-favored vehicle. The strong claim that those don't help the myopic is one thing I'll focus on. And the second thing is I'll focus on the proposal and sort of the implications of that. Some of the things I really liked in Ed's paper, I liked the heterogeneity part, both some people being myopic, some people not. And on the saving side, some people save, some people don't, even the people that aren't myopic. The other 2 out of the 3 that I want to emphasize are the second one here, the idea that we may have at least a second best optimal situation where some people oversave and some people undersave, and then in aggregate maybe we're close to some correct level, and that might not be such a bad outcome. And then the final bullet point here, I think is very important, is the thing that Ed's paper emphasizes about the fact that people's behavior may include a mixture of sort of mistakes and rationality. And more generally, not only may we have heterogeneity between people, but even an individual person may be a mixture of different cognitive, rational things and things that aren't so rational. And I'm going to make 4 sort of critique points. The first is that the strong conclusion about the myopic not being helped by these vehicles may change if we consider a wider range of cognitive behavior. One thing that characterizes this area, anybody who's read in this area knows this, is that there's certain phenomena we observe in the data, but there's multiple models that explain the phenomena, and the models have different policy implications. And at this point, for example, Bernheim and Rangel, who wrote a survey paper, said they make the strong claim, I'm not sure if this is true, I haven't read all the literature, that the alternative models really haven't been tested at all. Basically, they have a sentence that says that. And that's generally, I think, true at this point. So we have a very young field here. A second thing I'll talk about is that the proposal, at the point where you get to the proposal in the paper, it really sort of downplays heterogeneity in a way that is that's unfortunate. I think it understates the power of the proposal in some ways and overstates it in other ways. A related point regarding the proposal is under the system where some people oversave and some people undersave, we could end up with a concentrating the savings and wealth amongst a very few people, and that may have effects that undermine the approach itself. And then finally, I wanted to talk about, Ed already mentioned this, about the tightening moves. And basically, the way the paper's written, it sounds like the cash flow consumption tax is sort of perfect in shutting down the arbitrage. And that, on the other hand, if we try to tighten up the current things, that has all these problems. And I would argue that the case is much closer than that, and that you're not going to shut down the arbitrage completely, for example. So let's go on to the first point. So one thing that's true is that there's varieties of sort of myopia models out there, which are sort of equally compelling. Ed's analysis works really well if we have just a naive hyperbolic discounter. That's a person where the discount rate between now and say the end of the first period is really high. Then all the subsequent discount rates between periods are lower. That individual will in fact want to overconsume. And the postpaid and prepaid vehicles won't work. In fact, they might even help the person overconsume. That's one of the good points in the paper. And the paper's conclusion is quite sensible. It's really sort of stupid to try to have a policy that forces people to do what they don't want to do. But if we take another viewpoint, this is not Burnham and Rangel's survey paper, but they have about 6 2005 papers. In one of them, they have this very interesting model where instead of having hyperbolic discounting, there's random deviations from rational planning. So there's some probability each period that I'll go on a consumption binge and I'll depart from rationality. But normally I might be rational. And so this person then wants to, when they're not in the irrational state, they want to load things up in a way that prevents bad things from happening when they get into an irrational state. And these vehicles might really help here. We have these illiquid sort of IRA type accounts. The person can also do things like they can destroy their credit cards. So they get in the binge state, they can't get into their IRA, darn it. And they don't have any credit cards, right? And so, and basically this is really like one of Ed's points, which is Ed's point that people are a mixture of mistakes and rationality is really very much like the Bernheim-Rangel model rather than like the naive hyperbolic discounter model. So your conclusion about, the strong conclusion about these vehicles not helping, it's true under some models but not true under other models. And we don't know which model is true. We don't have the tests to back it up. And this flows out more generally. An example of that is mental accounting. We have 2 papers here. We have Alan Arbach's paper talks about mental accounting in a good way. It says, well, we can have mental accounting and people can separate out their saving and they can focus on it. And there's also the related point that there's a salience effect. If I go to my workplace, I'm 22 years old at my first job, you're going to have a 401k or you're going to have this and that. Then I start thinking about saving all of a sudden, maybe that's going to make me save more. That's the good mental accounting, the good side of mental accounting. Then there's the bad side, which is an Ed's paper, which is the right hand doesn't know what the left hand's doing. I focused at work on doing my IRA account, and then 2 weeks later, I'm in a different mental account, and I'm borrowing thousands of dollars on my credit card, right? So now I have a job, and I can spend all this money, right? And both of them involve, this, in some sense, a similar cognitive mistake, which is you don't consider your whole portfolio, but which way does it go? And both viewpoints are not only in the papers in this conference, but they're backed up in the literature. You can find literature and people supporting both of these impacts of mental accounts. So what is it? We don't know. One thing that I thought would be very valuable for Ed to do, since he has really smart guy and has a really strong comparative advantage in this field, would be to maybe tell us in this paper or some later paper, here's the different theories and here's the different effects and here's what I think. Here's what I think about which theory is true. That would really be cool, I think. The heterogeneity, downplaying the heterogeneity. The way this happens is we get to the end of the paper, all of a sudden there's sort of a barbell distribution. So most Americans will not save, period. They're completely inelastic. They're not going to save no matter what we do. And then there's these people that are going to oversave, and we're going to load up our incentives on them. And the people in the middle have disappeared here. But on the other hand, there's all this literature like the default options literature showing that high school financial education increases people's savings, that indicate that there are people that change their behavior, in some sense, permanently based on so there are some people in the middle. And the unfortunate thing for the paper is that some of the strongest points in the paper, some of the strongest points in the paper some of the strongest arguments involve the argument that the proposed scheme will shut off the arbitrage and all of a sudden all these extra schemes will work. And that argument becomes much more powerful if you have a big middle group of people who could be influenced by these schemes. The paper also ignores, in discussing the savings things, it ignores the possible heterogeneity in the savers. In many ways, the hero of the Ed McCaffrey story, starting from 10 years ago, is Andrew Carnegie. Okay, who is this person? This is a person who saved because just building up capital and building up an empire itself was the goal. So he near death, he didn't get money to his children. He gave some to charity. Maybe that's only because some was left over. So this is the pure paradigm. And if he had passed on to his children, as long as they had the same genes, were doing the same thing, this is the hero of McCaffrey's. This is the hero of McCaffrey's story. But there's other people too that may in fact be discouraged by a cash flow consumption tax, progressive one anyway. For example, Lifecycle savers who are aiming for really high, they want to buy a yacht when they're 40 or 50. Well, they're going to be discouraged from saving. And if you buy Ed's story that people that really want to can cut the savings rate down to zero, then these Dynasty savers and Andrew Carnegie type people probably already have no tax on their savings rate. And it might be that in the end you get a drop in saving under this kind of view from having the progressive consumption tax. Related points involve, what if we get into this world where all we're doing is encouraging the Andrew Carnegie type people? We give up on the other people. We say they're myopic, they're never going to change. We don't try to create any kind of savings culture or try to get them to save more. The question is whether if you end up then with 10% of the people have lots of money, the other 90% are wards of the state. The safety net's going to prop them up when they get to be 50. The question is whether this is going to work, sort of politically or dynamically. Or will these people, these 90%, decide that they want their money sooner, for example, and that Andrew Carnegie hasn't finished building a steel empire yet, even though it would be efficient for him to do so, but we're going to get the money now. And so one question is whether the ownership society sort of savings culture thing might be of value. There might be a value in creating that culture, even if the people don't save very much money. You might have these 30 or 40% of the population that are saving some money. They now perceive some stake in their IRA, and they're not going to vote. They're certainly not going to vote to take it away, and they're in fact going to be protective of it. And that's going to make the world safe for Andrew Carnegie. Whether that might be going on there. Finally, I wanted to talk about the tightening moves. And the paper does not compare the tightening situation that exists with the existing vehicles, that is the problem that people can just borrow, like they can do credit card borrowing, that's going to offset their IRA, with the possible problems that would arise under the proposal. In fact, under the proposal, there's just a bald assertion that arbitrage just wouldn't be possible, which is true if the proposal is there in its pure form. In contrast, the efforts to tighten up under the current system is patching up the marginal line. The individuals that still want to do the arbitrage. There's all these retail and credit market institutions that are going to help them. Okay, that's sort of the picture. One problem is that in practice, and this is something I think Ed already knows this, is that in practice something like the cash flow tax would have all kinds of potential holes in it. One thing is the ambiguity between consumption and investment, which is a more general point. But I put a sort of simple one here that's almost sort of, it's super simple. So you consume something now, you agree to pay later. It might even be a durable good, for example. That's sort of maybe the clearest example. You keep the money in a postpaid savings account. It accumulates with interest. It might be hard for the government to tell what you've done, especially if it's a durable good you've bought, and it's sort of, well, I'm not going to pay the full price. So later, it could have a rental contract. You have a rental contract associated with it, rather than a sale contract. There could be a clause about taking it back and how much it's worth. Just like when you buy a car, you have a car that you rent with an option to buy it. And then we'll have a clause in there that says if you die, the money immediately comes out of your postpaid savings account and pays the seller. Okay. And then financial and retail markets, they could encourage this. They could invent these contracts. They could design them so that they work as far as not falling inside the tax scheme. And then when you die, all the sellers get paid, and guess what? There's no money left. And now the last year of your life, all of a sudden there's all this consumption that should be taxed under this postpaid cash flow consumption tax. And well, sorry government, there's no money here. So we just consumed without being taxed. Okay, but there's many different kinds of problems that I think exist with this tax. And then in the current world, in the current situation, there's certainly things we could do. They're very harsh things maybe, but there's things we could do to end this world, to end this problem. Like, for example, to consider something really sort of out there. Suppose we have a law that says when you get to be 59 and at all older ages, you can go through some simple process and we'll excuse all your debt, including secured debt like the mortgage on your house. Suppose we had that was law in the United States. What would happen? It'd be very hard to borrow money when you start getting in your 50s, and all the contracts say you got to pay back when you're 58, and so on and so forth. And basically, and the good side of that, from the view of this scheme, would be that when you get to be 59, you'd be sitting there, you'd have all your IRAs that have all their money in it, all your debt would be gone, etc. Now, would this have problems with it? Of course. First of all, there's a big drop in the economists in here immediately will have this horrible feeling about what's the drop in welfare from people not being able to borrow, right? Then we have a political problem that we're going to throw people out of their houses when they're 59 because they can't refinance their mortgage. And there's evasion possibilities. But the point is, the general point is that the tightening problem exists both in the proposal that Ed had and in the current world. It would have been very interesting to sort of discuss that more as a trade-off. And finally, I have to discuss the known. I didn't put it in my slides. The known, the known, unknown, unknowable. My view is it's like there's the first and the third category really have almost nothing in it. Why? Because when you're talking about known, we're talking about, is this elasticity known? Well, of course we don't know the exact number. There may be physical laws where there's an exact number, like E equals MC squared, and it's exactly 2. But most of the things we talk about don't have that aspect. And the unknowable, does that mean that we have our posterior probability is that there's infinite variance and that the value of the elasticity could be anything? I don't think there's anything in here we've talked about that anybody would assert is that unknowable. So if we have these posterior probabilities, what should be the one for this one? My view is that we should have a lot of posterior probability on the possibility that these phenomena are very important, but that it's scattered all around, and we don't know which theories are really which real behavior mechanisms or real things are underlying some of these phenomena we see. We also don't know what the connection to policy is. So we have a lot of possibilities, and also we have very high variance. That's where I would argue you should have your posterior probability. Thank you.
Everybody did a wonderful job. Questions? Want to move up there so they can aim easier?
Well, I think we know that it was a good move to cede time to Strnad. Let him think.
First question, and then Alan.
Can you kind of help me understand the basic premise that people don't say? So there's a new paper by Carl Schultz coming out in the Journal of Political Economy where his very complicated model, he suggests that about 80% of Americans are saving optimally for retirement, and 20% are. There's work by Eric Hurst at Graduate School of Business, University of Chicago, kind of a nod towards Aesop's fables. He categorizes people as grasshoppers versus ants, and he finds that about 80% are ants, about 20% are grasshoppers. This 20% number, why these two authors using different data come up with 20%, I don't know. It turns out that if there are 20% retirees who are wholly dependent on Social Security, by the way, maybe this is the same group who are planning for that. There's work by Chris Carroll and Angus Steaton that people are maybe buffer stock savers, which means they have some target permanent income. Chris Carroll then argues that sometime around the age of 50, people have this epiphany and they become lifecycle savers, say around age 50. But they're impatient earlier in life, so they maintain these low wealth targets. I've done some work with Eric Hurst, looking at whether or not low-income households respond to these asset limits and welfare programs. We find no evidence, but that they do. But in separate work, I do find that where I decompose the rich-poor wealth gap using 12 years of data. And here, the thing that I think some of the literature is lacking on is looking at long time horizons and some of the empirical work. So the data I had, looked at condition on permanent income defined by a 12-year average. And I found that the poor were actually quite responsive, looking at that long time horizon over a little over a decade to changes in their income position. So they did actually accumulate assets out of income. But one of the things that kept them down were certain other demographics. So marriage is important for asset accumulation, for example. So there's a lot of heterogeneity that can be explained by some basic demographics, household structure, for example. And so I've just been trying to grapple with the fact that people don't save when we have some other evidence looking at more life cycle, long-term horizons that people are doing some saving.
Well, I think, the two basic responses. One is back to heterogeneity. And I take a lot of Jeff's comments to be, I just need to work through the ramifications of heterogeneity more. For example, I don't think there's a barbell thing at the end. I mean, that was just sort of kind of quick writing at the end. And, one thing about a consistent consumption tax is that that's fine for all that. I mean, if people are saving, then a consistent consumption tax, facilitates life cycle savings. It helps people within the middle of Jeff's barbell. So there's not really any reason not to go to a consumption tax for them, and it would be a consumption tax that would work. So I think people are heterogeneous, and clearly some people save, and within savings motives, I think they're different motives. The second response is, again, I'm not an econometrician myself. I mean, I looked at a lot of the data. The data's gone back. People have been doing this for 30 or 40 years now, so you can look at Doug Bernheim's work and Feinberg and Skinner and Venti and Weiss and, this endless thing. But then when you step back, you say, well, as a nation, I know there are difficulties in measuring the national savings rate, but it looks like savings is declining. It looks like we're running persistent and large trade deficits. The surveys of most households seem to show modal people don't save. If you're just looking, you've got these sort of blind, I'm not saying you do, but people have these blinders for the tax-favored vehicles. Well, you look at participation rates in them. One of the graphics in my paper is about how many people are maxing them out. And basically nobody who makes less than $75,000 a year in wages, 3% of the people who make between $50,000 and $75,000 in wages are maxing out their 401k. So something's not missing, or something's missing. So what I do with that is I just step back and I say, look at first principles. And first principles tell us that this tax system that we have, that has on the one hand an income tax structure and on the other hand these ad hoc vehicles, there's no tax reason why that structure should really work to increase savings. Whereas if we change the default rules, there would be. So, for those people who are already saving fine, I have no problem with it. They're not going to be hurt by a more consistent change. You just get rid of the sub-rules and the complexities with the 401k plans and so forth. But I don't know whether it's 20% of the people who are not saving. It certainly seems to me like there's something missing out there, but I don't have the counter sites. I wrote down some of your sites. I'd like you to send me more, and I'll look at them. But it seems to me that people are having this argument over here, and the macro data is basically showing, I mean, it's kind of the Larry Kotlikoff story, where a train wreck waiting to happen, and the federal government's running a deficit. We've got a trade deficit. Individual people have deficits. So something's not adding up.
Alan?
Yeah, I'm sorry Larry's not here, because he could have told the same story you did and then explained why a retail sales tax is the answer.
At a 23% rate? Yeah.
My comment is just something in your presentation. I don't think there's any really good reason why one should view capital accumulation per se, unless you think there's somehow social externalities associated with capital accumulation, and I'm not convinced that there are. saving produce this private savers capture, except for the taxation of capital income. Private savers are capturing the benefits of their saving, and I don't think we should get off on a detour thinking about the importance of having a higher national capital stock, except insofar as what it provides for the individuals who save.
Well, I mean so that you're just pushing at the microfoundation point, but even if you got a lot of people who are under saving,
I'm not saying we shouldn't encourage people to save. I just don't think there's not an additional social benefit to having capital.
Right.
And
I mean,
I don't think we should dwell on that point.
Yeah. I mean, we can talk about that also, or you'll have to explain that to me in New York, because I would think there would be. I mean, in the kind of, those macro models you get with social production functions and some elasticity of substitution, you have more
additional effects.
Right.
You may cause real wages to rise and rates of return on capital to fall, and you may have beneficial effect on the distribution of income.
Right.
Fine. But I mean, in terms of capital just having more wealth,
right,
the nation, its benefits are conveyed by the individuals having more wealth. I don't think there's any additional benefit to having more wealth.
Okay, although I think those distributional things are important. So one thing I say in the paper is, I think the current strategy is poor people don't save enough, let's force them to save more. And I say, well, you can actually help the poor by allowing the rich to oversave, quote unquote, oversave, and giving up on the policy. I mean, not giving up in the sense, I don't think you can still do all the things you want to do, but you can have a saver's credit, you can do all that stuff within a structure that's more systematic. But the one reason for doing that is you help the poor people out. You help wage earners out.
I mean, one thing about go ahead.
We better move on. Next question, and then after that, Jim Perturba, and then James, and then we're going to have to close it off.
My question is, or point is that you haven't gone to the fundamental part of fundamental tax reform in this paper, I think. Because you focus on, let's looking at the savings, which is an intermediate target to saving. At the end of the day, we care about welfare. That's, of course, a pretty ambiguous concept. But it gets important, it seems to me, in your case, because you're focusing on these behavioral biases, which may therefore have something to do with the utility functions that are relevant to the real analysis of this tax reform. So I guess my question is, how does the behavioral approach influence utility functions, and how would it influence welfare calculations in this kind of...
Yeah, well, I guess it's sort of the intellectual, the sort of epistemology, the way we think about tax reform. So I think the way we think about it is, basically you do these models, and Alan's got them in his paper, where if you've got rational life cycle savers, then these things don't really make sense. These ad hoc, vehicles don't make sense. But we have these things, we like these things, so then we look out there in the world and say, people are myopic, so we need these things. So it is tax policymakers who they're not cutting edge behavioral risks, they're by and large skeptics of behavioral economics, but it's tax policymakers who are using the insights of behavioral economics. So what I'm saying is, we've got something wrong. I think you can see throughout the whole yesterday and today. I've got this motif of Groundhog Day running through. I say, this looks like a lot of Brookings conferences from the 1970s and 1980s. Rome is burning, and we're still debating income versus consumption and border adjustment. And, there's something to be said for Larry Cott, we're part of the problem because nobody wants to listen to us. So if somebody comes riding into town on a simple, fair, flat platform, they're going to win. So I'm saying, fundamental tax reform as a process, as an intellectual process, has to sort of pay attention to behaviors. And I think the way to do that, behavioral economics, the way to do that, instead of using these ad hoc things to try to change individual people behavior because you think one irrational mechanism can counteract another irrational mechanism and get people to do something that the analytics suggest they don't do. Instead, I say, as Pam was saying, let's look to marketing. Let's look, maybe some of these things, maybe it matters whether people fill out forms or not. Maybe there's a form version.
Maybe with this behavioral biases, we really don't want people to do that. Maybe we don't want them to save. Maybe it's just it just changes the whole rules of the game.
Well, that's the thing. So that's a good point, put that way. So one thing when you say, what are we talking about with behavioral biases? Because people think, that, and this gets to a point of Pan's making, that you can solve it with just higher discount rates. In fact, the hyperbolic discounting literature of George Lowenstein and so forth, the behavioral biases are about inconsistency. It's about, I want to save. My future self wants money in the bank, but I can't do it today. So there's an intertemporal gap, and the question is whose utility counts. And in the hyperbolic discounting literature, the characteristic feature of that literature is a non-constant discount rate between successive periods. So between now and period 1 from now, I have a high discount rate, and then I'm consistent through time after that. So it's a within subject inconsistency. So that leads you down the road of paternalism. We're helping these people help themselves. And I just, I think there's a reason to do that, but there's a reason to also be realistic about the present period bias.
Yeah, but Jeremy?
Two things. First, I think on the savings empirical description, I feel obliged as one of the participants in some of this debate to just say that I think you're probably a little bit too harsh on the evidence that these kinds of programs have had some favorable effects on savings. Bill Gale and I, who for a long time have been on sort of opposite sides, and are probably the two most conciliatory members of the opposite sides team, a couple of years ago at the Social Security Administration, we're on a panel together. And loosely speaking, I think Bill was willing to come to maybe a sort of 25 to 30 cent on the dollar new saving on some of mostly on the 401ks. I think the 401ks is easier to evaluate than the IRAs because you've got some heterogeneity across households. I was kind of in the 60, 70 cents on the dollar. But I did, at the end we basically both agreed that if people left the audience thinking that maybe it was half, and you got this much consensus that this was a huge victory relative to people starting out at 0 and 100. I think the aggregate empirical stuff is the aggregate saving rate. We know there are a lot of problems with measuring the NICA saving rate, and we know that we've had these huge asset revaluations during the last decade or decade and a half, first in the equity market and then in the real estate market. And it's very hard, I think, to run the counterfactual and to say what would saving have been had we not had these programs in place, and we'll never quite know the answer to that. The other thing on the behavioral economics here, I think that as you've written in other cases, it's important to underscore that once you leave the rails of the standard neoclassical model, we're talking about tax reform and tax design here, but when we put on our public finance welfare economics hats, that once we're in this new world of not knowing quite what the right utility function is or whether people are internally inconsistent, a lot of the other things that we're accustomed to doing as public finance economists suddenly become extremely difficult. We don't really have a compass for figuring out how do we do welfare analysis. Do we think about it's this say is it my today consumer? Is it the one that said I wish I didn't have that big chocolate cake last night, or is it the one that last
Right.
So who's am I grateful to John Diamond or am I angry at John Diamond? It's just a little tricky to figure out how we do the welfare calculation.
Yeah. And I agree. And putting both those points together, though, in a way, there's not an either or here. So I think people are trying to defend the status quo, which has an income tax with these ad hoc vehicles. And as a social policy to get 50 cents on the dollar, given there's a deadweight loss to the tax you're getting the 50 cents from, that's not a spectacular success. So I'm saying, it doesn't, and back to Jeff too, we don't have to have an either or fight. It's not tightening up the arbitrage or change the background rules, but change the background rules. And I do think that is kind of an unknowable thing. What sort of society would we be if we had tax and other systems set up to really encourage savings and discourage consumption at the margin? We've gone the other way for 200 years, and that's part of our success. We've been a great consumerist society, and now we sort of have to change gears. But you can still have 401k plans and employer matching credits and government matching credits within the structure of a consumption tax.
James?
Two quick observations. The second was what Jim just said. How do we evaluate excess burden and so on, based typically on individual utility functions that are the standard form when we don't really know if those are the utility functions people are choosing. But the other is a plug for the behavioral economics, and also I think in particular the notion that people represent a mix of behavior. The analogy I always found useful from a different discipline is from Stephen Jay Gould, the late great Harvard scientist who wrote a variety of books, but one of them was entitled Full House. And his point in that book, I think, is that you can't really understand the way in which systems behave, the way in which systems evolve, even in the context of evolution, by looking at the behavior of the representative or the average individual. You have to look at the extremes. And in the context here, you have to recognize that people are very different. The same person may behave very differently at different points in time. Some people may always be expected utility maximizers. Some people, in the context of compliance, always pay all their taxes, regardless of whether the incentives are there not to pay taxes. And so, recognizing that heterogeneity, I think, is a particularly useful insight from the beginning.
Right. Well, thank you. And just on the first point, which was also in Jim, I mean, that's a sort of standard critique of behavioralism, that we're out of the welfare economic mode. I guess one of the things I'm saying is, back to the previous comment too, I'm not sure that tax policy has to take that head on, particularly because there does seem to be this answer where if we made the system, if we care about savings, be systematic, and don't try to encourage savings in a system in which there's no rational reason for it to work, you can make those kind of conclusions without doing, summing individual utility functions. And if you look at, I agree with Jeff that it'd be fun to sort of sort through all the behaviors. The one behavior you really shut down is that hyper-myopic person who is in a high tax bracket and is getting more money today because he's putting money into an IRA, and that enables him to consume more today. Well, not only can we say he might be wrong as a utility maximizer on his own lights, but we can also say he's spending the government's money. That's what he's doing. I mean, it's not a pure rational arbitrage, as Alan has taught me, but you're forgetting the fact that the value of the deduction today is going to come out later. So you're playing with house money there. So at least we can shut down things like that in a way that actually finesses the deep methodological questions.
And then we shut down this to go to the final act, the crescendo. Auerbach, Aaron, and Priscilla.